Hi guys, Dr. Robinson. This is the March 31st, 2023 meeting of the Money Masters Investment Club. Just a few things here today. I think I've got 10 slides I want to go through, but I'm going to go through them fairly quickly. I want to try to make our videos a little bit shorter than traditionally. So this is the meeting of March 31st, 2023. Financials for the week. Okay week. We did solidly perform pretty well. I've been changing again, my charts because the market has kind of gone through another rally. We keep shifting from rally to a decline, back to a rally, back to a decline, and we're back to a rally again. I've had to go to my charts, but the cool thing here is that I've actually gone to some longer charts, and I'm sticking with the trade a lot longer. A couple of trades last week, I stayed in for one of them. I stayed in for $1.57, which is unusual when the VIX is this low. The VIX is a little over 18 right now, by the way, guys. That's down from 3 weeks ago where we were at 30. So the VIX has fallen pretty hard. Volatility has come down. The markets are very dangerous right now simply because, again, going back to some of the stuff we've talked about over the last few weeks, the retracements in the market are huge. And you can be on the right side of the trade and get scared out simply because the retracements come down and it puts you so deep underwater you have to cover or you have to try to strangle. And strangling is dangerous right now with the retracements the way they are. So we're trying to do everything we can not to strangle if we can. My effort towards that is to be going to longer charts and holding a position a lot longer than I would normally hold. Now, the downside to that, of course, is that I'm not doing as many contracts. Sometimes I'll do the 450 contracts. I'm not doing 1,000 contracts at all on anything right now. So the most I'm willing to take at this point is 450, and that's usually in the morning. In the afternoon trades, I'm going down as low as 100, and there's been a couple of times this week I actually did 50. So I'm doing the smaller contracts because I want to hold longer. And my thought here is if I can get, let's say, 100 contracts and hold them for 4 times longer than I would normally hold, instead of trying to get 10, 15, 20 cents, hold it for $1.50 or something, the next thing you know is that I'm actually making as much money as I would have made if I'd held the bigger contracts for shorter periods of time. So at the end of the day, I'm trying to do this in a way to mitigate the risk because the risk is really high right now. We've got to be careful in the markets because they are susceptible to wild swings. Now, again, last week we saw some wild swings. A lot of it had to do with Fed speakers. And again, something that's kind of the bane of our existence, but they've been doing some of that stuff. In any event, all of that to say this, we had a pretty good week. We're up 33 cents for the week. Again, holding contracts a lot longer, but not as many contracts. Ending NAV 25.34 for a gain this week of 1.32%. Still struggling to get back to where we were, but the market just isn't cooperating real well, but should be getting there here. Now that I'm holding these contracts longer, we should get back to where we were very shortly. That's my hope anyway. We'll see as we go into this week. The market's kind of gone through another bull streak or a bull run. If you remember a couple of weeks ago, I told you that we had gone into like a bearish market where the market wanted to come down because a lot of people had priced in the fact that they believed that the Fed was going to lower interest rates this year. I still say that can't happen. There's no evidence that the Fed is going to lower interest rates. I think they may stop raising interest rates this year. I think we've got probably one more increase coming, probably in May. And after May, I don't think we'll see any more increases for a while. Having said that, that doesn't mean just because they're not going to increase, that means they're going to decrease. A lot of people are pricing in a decrease in interest rates. That's not going to happen. I think once the market sees that or realizes that or prices that in, we're going to start to see some declines back in the market. However, as of right now, you can see the market bias, if you will, is very strongly up. All our oscillators, all the things that we look at in terms of what the market is doing, very strongly buy signals. So the market is very bullish right now. I don't think it's going to last. If it does last, it's going to be another week, maybe 2 weeks before it starts to calm down again. We are back at some, not quite to the levels we got in February of this year, but we're kind of getting close. Whether we're going to make it back to that high of, let's say 4,200 or so, and then try to come back down or not, I'm not sure. We're at 41 again. A couple of weeks ago, we were down to 39, or actually 380 on the 390 on the Spider, and on the S&P itself, we were in the 3,900 level. But right now, the market is relatively bullish. I don't think it's going to stay. So the markets will remain bullish this week for the rest of this week, but I do think it's going to start to slow down going into next week. It may even start sooner than that this week. We do have a lot of data coming out this week, but there's a couple of other things that are kind of happening right now concurrent with some of the data that's coming out. So let me talk about these real quick. And I don't spend a lot of time on these because these are a little bit complicated and too much for a video where I'm trying to keep it short. But we're starting to see a decrease, or I'm sorry, an increase in CTA flows. Now, CTA flows, CTA stands for Commodity Trader Advisor. These are firms and individuals who trade commodities, and there's been a massive inflow into the commodities market. And if you pay attention to things like oil or grains, you've seen prices come up lately, and that's because of these folks. These folks have been pushing, again, the laws of supply and demand. When people start buying more and more, prices for things start to go up. So we started seeing prices for some commodities going up. That includes things like silver and gold and aluminum and steel and all the metals that companies like General Motors need, and aluminum that Boeing needs and stuff. But also gas and oil have been going up lately. A couple of weeks ago they were down in the oil was at 60, I think $66 a barrel. Back into the about $74 a barrel again right now as I speak. So the prices for things have been coming up, and that's a direct influx or result of what these folks are doing. We're never really sure why they're buying so much. Maybe they're trying to lock in prices at when they got down to low prices, they wanted to lock in those contracts and stuff. But at the end of the day, we have seen a massive influx going into the commodities market, but that money is actually starting to level out and actually there's indications that it's slowing. I don't have a chart for it because the chart is proprietary and I can't take somebody's chart. But if you look at a chart on CTA flows, the money is starting to trickle out of the CTAs now. So they've kind of run those contracts up and they're kind of happy with what they did. And for the moment, there doesn't seem to be any new money coming in, or not massive amounts of new money coming in. So we're going to start to see these prices for things start to slowly come down, unless of course there's a spike. For wars always make a spike or if something happens. But short of that, we're starting to see money flows coming back out. So the likelihood, based on the charts and based on the data that we have, money flows from CTA is going to start coming down midweek. And let's call it, I'm assuming that it's going to stay a little bit high and maybe start to peter out a little bit by the end of the week. So I'm kind of expecting the whole week for the most part, because it's never really it's on and then it's not like a light switch where you can turn it on and then you turn it off and it goes away real quick. These things take time. So I'm assuming for the next week or so, we're probably going to still see another drift higher in the markets. But as this CTA money starts to ebb, it's going to bring the markets down a little bit. There's also the Treasury General Account. This is tax receipts that deal with the Fed. So Treasury tax receipts should push the Treasury General Account held at the Fed higher off its very low levels, which will suck liquidity out of the market. So in combination with the commodities traders doing their thing, we've also got money flows affecting the Treasury receipts on tax flows. So again, as this stuff comes in, the amount of money at the Treasury or the amount of money in the Fed is going to be less. So liquidity is going to dry up a little bit at banks. So again, there's going to be less money to lend, and banks are already a little bit nervous about lending anyway, simply because of all the things that have been happening over the last, what has it been now, 2 or 3 weeks. So banks are already hesitant to lend. So this is just going to make it even worse. So liquidity is starting to dry up a little bit in the markets, and this is just another factor that goes into that. Again, it makes me believe that the market is kind of close to a peak for the moment. I'm not saying it's going, and by the way, this is just, I don't have a crystal ball. I don't know what's going to happen. It's just based on the data that we're looking at, the market's probably going to start to level off here and maybe start to go back down. Increasing bank reserves. You can see the bank reserves over there on the right, or on the left rather, in that black screen. You'll notice that there was a spike. This was about the time that the banking crisis first started coming out. So that was in early March or mid-March, whatever it was then. but we started seeing the banks increase their reserves. And they increased their reserves because they weren't quite sure. Nobody was really sure what was going on. So banks kind of got to the point where, like, what's going on? Is this 2008 again? And everybody was all worried about it. And so they started increasing their reserves to make sure they had money to pay their bills should anything happen to the economy. Well, as time has gone on, and we realize now that it's not really a banking crisis more than it is stupid people running banks type of crisis, where they just didn't handle the duration risk very well. Now the banks are kind of basically saying, you know what, we don't have to worry about this. So again, we're starting to see some of those outflows uh, in the reserves. So again, with outflows here, even though they went out pretty hard, we're still going to take out about another $100 billion of liquidity out of the market as this kind of gets back into normal. And again, any of these things individually aren't going to be that big on the market, but if you think about them all together, with the CTAs, with the commodity traders, with the Fed, the Treasury tax receipt thing, and then of course reserves, we're seeing massive amounts of money kind of flowing out of the market and into the Fed and into the repo market, or technically the reverse repo market. So we're starting to see some increases there, and that's going to decrease liquidity, which is going to make it harder for people to borrow money, which is going to make it more likely we're going to recession, which is going to make it more likely that stocks have to come down because we have to reprice on earnings. It's all interconnected. I've got the money market here too, and this is a big one. A lot of investors are actually moving money out of banks. Banks, haven't paid a lot of interest in the past anyway. We've started seeing some increases in interest rates in the banks, but if you think about it, money markets are actually paying a little bit more. So as banks kind of show a little bit of trouble here, and again, I don't think this is a banking crisis, but a lot of people perceive it differently, of course, especially people who don't really pay attention to this stuff. A lot of people are just worried. They don't want to have their money in a bank that, if they can have a money market account where you got a higher interest rate and there's a lot more cash in those systems. So there's massive inflows into the money market accounts, which are, investors fleeing banks for better interest rates. That money will likely head into the reverse repo. I kind of talked about that just a second ago, but it heads into the reverse repo facility. Reverse repo, if you remember from the stuff we've talked in the past, whenever the Fed wants to increase or decrease the money supply, they do that either through repos, and these are called repurchase agreements. We just nickname them repos. But a repurchase agreement is where the Fed buys bonds from a bank, and of course, when the Fed buys something, they pay cash for it. And if you're buying it from a bank, you're basically giving cash to the bank, and that increases the money supply, makes interest rates go down. Well, the Fed's not doing that right now. The Fed is doing the opposite of that. So we call that a reverse repo, a reverse repurchase agreement, where the Fed is basically going to the banks and saying, hey, we want you to buy some bonds from us. So as the banks are forced to buy bonds, that decreases their money that they have available to lend, that decreases their reserves. So they basically have to get tighter on lending standards because there's less money in the marketplace. So this money going into money market actually has the same effect. It's not the same. It's not the Fed doing it, by the way. It's just the market itself doing it. So the market is kind of saying, hey, I'm going to move my money out of a bank, which leaves a bank with less money to lend, and move it into a mutual fund, a money market mutual fund. So that in and of itself, even though it's not from the Fed, it's not the government doing anything, it's just investors making decisions about how they want to manage their money, that does decrease the amount of money that a bank has to lend, and therefore less money in the marketplace means higher interest rates overall. So again, this is one of those things that could push interest rates a little higher going forward. We'll have to see. I don't know that they're going to go too much higher than where they're at, but at the end of the day, this is something that has a big effect on rate. My last screen is just a reminder, and we've talked about this one before, about the Fed and interest rates. And we've talked a lot about the yield curve on the Fed money, or interest rates rather. And the yield curve, you remember there's a couple of bonds that we always pay close attention to. The most important is the 10-2, but the second most important to me, now I pay more attention to the 10-2, the 10-year versus the 2-year bond. Some economists pay a lot of attention to the 10 and the 3. Whichever one you want to go with, it doesn't matter. I like the 2 year because it gives me a little bit more time to make decisions or kind of look at trend lines as opposed to a 3 month bond, which only lasts for 3 months, so it's more volatile. Remember, when we talk about short bonds and stuff, they have less duration than a 2 year bond. And to calculate the risk to the economy, I want a little bit more duration. I want a little bit more time to make a decision to see what that volatility is, how it impacts the economy, et cetera. 3 month is just not, there's not enough duration in that for us to make any really good decisions. But having said that, and I've said this before, when you look at these are the biggest indicators of a recession. And you'll notice now, this is a chart from the Federal Reserve out of St. Louis. It's called Fred. And when I go to Fred, I can't go back any further than 1982. I'm sure somewhere they've got a chart. I just don't have time to look for a chart that goes prior to 1982 because I know intellectually, by the way, we've done this research before. If we go back all the way to World War II, which is in the 1940s, of course, this trend line still holds true. And the trend line I'm talking about is you see that zero line there. Whenever the interest or the difference between the, and we call it the spreads, by the way, whenever you see the difference between a 10-year and a 3 month bond go negative or invert the way they have, whenever they get to the point where they cross over that zero line, it's followed there shortly thereafter by a recession. The recessions on this chart, by the way, are the green or the gray, not green, the gray little bands there that you see kind of throughout. So you have one right around 1990. There was one in 1982. Of course, that was when Jimmy Carter was president, or he had just lost the presidency, and Ronald Reagan had his treasury trying to figure out how to get interest rates down because they had jumped up to 16% while Jimmy Carter was president. So we had gone into a recession for a little bit, but we had to do that because they had to just drastically reduce the money supply. So in 1982, a little after 1990, so going into 1991, you can see another one there in 2002. That was mostly the crisis from 9/11 and stuff. You also see in 2008 the financial crisis. Shortly after that, we went into a pretty steep recession. That was the steepest one or the longest lasting one for a while. But you'll notice in 2020, now that one's not fair. We can't blame that on anybody. That was COVID. So the COVID one was relatively short, but we did go into a pretty steep recession. But look at the far right. Number has never been this worse or this bad. It's the worst number we've had since. And again, I can't go back too much farther on current, and I don't have all of my computers where I can go back and look at these rates, going back to the early 1900s and stuff. But since 1982, that's roughly 40 years. So in the last 40 years, we've not seen the spread get as big as it is. And I know that in 1982, it didn't get that low either. This is the lowest it's ever been, I think, since about the 1960s or 1950s. So at the end of the day, we're seeing these spreads between the 10 and the 3 month bond at rates or levels we have never seen before. It's and you'll notice at the top left there, it's 1.37. Normally you see it might be 25 basis points, but 137 basis points is a massive amount of spread difference between a 10 and a 3. This is going to be followed by a recession. Now, some people say we're probably already in a recession. I don't think so yet. GDP numbers are still good. Sales are terrible. Sales are a better indicator of the economy than GDP, but still sales are positive, even though they're not very good. They are positive. So I don't think we're in a recession, but I do think we're going to be there shortly. It's not going to be long before we are there. And the problem with this chart, though, is that it doesn't give us any good idea about how long it takes for a recession to hit after you hit below that zero line. Sometimes it happens fairly quickly, like it did in 2000. Other times it doesn't happen as quickly, like it did in 1990, and in fact, 2007, 2008 area. We did go into recession, but it actually took till mid 2008 before it actually started impacting the economy. So again, we don't know how fast it's going to, or how long it's going to take to get to that. But we're going to, with this level this low, we're going to get into recession. What does that mean for things? Investors are eventually going to wake up and realize the Fed is not cutting interest rates. The Fed is going to keep course on raising interest rates, or at the very least holding interest rates level. Again, I do think they're going to raise them again in May, probably just 25 basis points. It's data dependent. I mean, data could change between now and then. We did get some inflation numbers, and the inflation numbers weren't as bad as expected. They're still not good. They're still twice what we would normally expect, but they're getting better. So there is a possibility the Fed has kind of done the right thing, or they're starting to look at the evidence and say, at least inflation is not getting any worse. It may not be getting a lot better, but it's not getting any worse, certainly. And that means that they probably can hold interest rates where they're at as opposed to allowing the interest rates to go back down. If they allow interest rates to go back down too soon, inflation is going to spike up again, and that's something they can't allow to happen. So having said that, I think, again, and I'm getting a lot of people asking, am I yet bullish in the market? The answer is no. I am starting to think that there might be a point in time where we can get into the market, maybe not on individual stocks, but maybe into the market as a whole, just to kind of spread the risk out. We'll talk about that in the coming weeks, but for the moment, I'm still relatively bearish in the market. I do expect the VIX to pop back up. The other times in the last few months, the last time or the few times that the VIX has got back down to an 18 level, I think we hit a 17 at one point back in, and I don't remember when it was. It may have been early or late January or something. But we did hit a 17 level. And as soon as we did, we kind of spiked right back up to the 2021 level. I think that's probably going to happen again in the next couple of weeks. So put your seatbelts on. We're still on in a pretty good situation where since we're not holding overnight, we don't care whether the market spikes up or spikes down. The downside to this, and I will say this, and I don't have a chart to show it to you, but it's something that the folks on the daily call know. A lot of the market moves lately are all in the morning in the futures. The market itself hasn't changed a lot once the market opens. Most of you guys know that the market opens what we call the cash market. The cash market opens at 9:30 in the morning and ends at 4 o'clock. But before that, we have the futures market. And then, of course, we have a little bit of an aftermarket. It goes out until about 8 o'clock. The futures market are the ones where they push the market up or they push the market down, depending on whether they're bullish or bearish. And the cash market opens wherever they left off. So sometimes what will happen, and this happened the other day, where the futures market pushed the stock market up before anybody can trade. And while this is happening, by the way, there's nothing we can do to deal with this. But they'll push the market up maybe 50 points. So the market opens 50 points higher. And then the market sits and trades at 50 to maybe, it might go up maybe to 55 points or down to 45 points, but it stays in its relative short range. And that's what's been happening lately. So a lot of times people call and they say, well, Richard, the market was up 60 points today. And why didn't we get, 30 points of that in the market? Well, the reason for that is it was the futures. The futures guys ran the market up, and when the cash market opened, there was very little movement in the market. The market may have gone up again, another 3, 4, 5 points, come down 3 or 4 points as the market does its thing. But there's not really any chance for us to make any big money because the futures guys grabbed it all. I'm hoping that we're not going to see that again with the VIX coming down. That kind of behavior stops or slows down a little bit. I haven't checked the futures. Now, we're not going to know the futures until Sunday night, 6 o'clock. But in any event, when you see the futures, if you look in the morning, you watch the early morning financial news, you see the futures up big or down big. Those are the people who are pushing the market around. And just because, market's up 60 points for the day or something like that, doesn't mean we had 60 points for the day. It might mean we only had 5 or 6 points for the day. And trying to make money on 5 or 6 point move in the market is tough. And that's why we've been struggling so much lately with having to hold shorter periods of time or going to longer charts to hold for trends and stuff. Even on a long trend, we're still only getting maybe 100 basis points. The other day, I held on Thursday, I think it was Thursday, I did 154 basis points. But still, I held that thing for a little over an hour. I think it was about an hour, 15 minutes, hour, 20 minutes or something. I had to hold it for an exceptionally long period of time. Worked out, but it's not something I would typically do with 450 or let's say more than 450 contracts. That's just too much risk. So having said all that, the market's just kind of status quo right now. It's mostly moving sideways. I don't think it's going to continue moving up too much more. It is trying to push higher. I've been telling you for the last 2 or 3 weeks that the market, I think is more likely to go down than it is to go up. But right now it's not doing it. It's not going down. It's not really going up that much either. We're back to about where we were in February. So the market's in this trend line or this channel between, let's say 390 on the spider up to say about 415 or so. And probably going to stay that way for a bit. I do think it goes back down. Having said that, if you guys have any questions about anything, just let me know. And other than that, we'll see you next time. Thanks, guys.